Greetings, my dear students. Today I'd like to discuss with you the topic Dow Theory. Dow Theory was formulated from a series of editorials written by Charles H. Dow in Wall Street Journal from 1900 to 1902. Dow Theory identified three types of price movements or trends. First one is primary trends, second one is secondary or intermediate trends, third one is minor or short-term trends. These three types of trends can be compared to tide, waves and ripples. First one is primary trends. The primary trend may be a broad upward or downward movement that may last for a year or two. The primary trend can be either rising or falling. When there is a wave of rising prices, we have a rising or bull market, that is what known as primary bull market, and when prices are declining, we have a falling or bear market, that is what known as primary bear market. Three stages are identified to both primary bull market and primary bear market. These are the phases of primary bull market. First one is accumulation phase, second one is public participation phase, and third one is excess phase. Here you can see the different phases of primary bull market. T1 represents the accumulation phase and T2 represents the public participation phase and T3 represents the excess phase. The movements opposite to the primary trend like B1 and B2 are known as secondary trend. The first phase in primary bull market is accumulation phase. And accumulation phase is the starting point of upward trend. The informed investors means investors who have the knowledge about the changing market trends consider this as a starting point to enter into the market. Means they will purchase securities at this point as they are expecting a bull trend. Accumulation phase starts at the end of a downtrend where the whole market conditions were worst with excessive pessimism. So in the beginning of a bull market, means in the beginning of the accumulation phase also, investors will be a little bit pessimistic. But some patient investors who find value in buying securities for a long period will purchase shares, and they thought that this is the correct time to buy stocks and they will become rich. However, the accumulation phase can be the most difficult one to find out because it comes at the end of a downtrend. The next phase is public participation phase. This is the longest phase and there will be advances in price and earnings begins to rise again in this phase and confidence starts to come back, and this encourages more and more investors to buy more securities as they are expecting a future price hike and the price will increase again. The last stage is excess phase. During this phase, public is fully involved in the market. Confidence level is extraordinarily high in this phase. Price is also very high. The excess phase is one in which the smart investors starts to sell their holdings to those now entering into the market. The upward moves starts to show weakness. It could be another sign that the trend may be near the start of a primary downtrend. Now these are the phases of a primary bear market. First one is distribution phase, second one is public participation phase, and the third one is panic phase. Here in this graph you can see the different phases of a primary bear market. Here B1 represents the distribution phase and B2 represents the public participation phase and B3 represents the panic phase. The movements opposite to the primary trend like T1 and T2 are the secondary trends. And the first phase is distribution phase. This is the opposite of the accumulation phase during a bull market. The informed buyers realize that business conditions are not quite as good as once thought. Then they will start to sell stocks. But the overall sentiments continues to be optimistic as it is coming from a primary bull market. Like accumulation phase, the distribution phase can be difficult to identify in its early stages, but in the middle to later stages of the distribution phase, we can see price starts to fall, and more investors are anticipating weakness and they will sell their stocks. And the next phase in primary bear market is public participation phase. This is the longest one, and there will be the largest declines in prices, and in this phase companies report lower profits and dividends. And the third phase is panic phase. In the panic phase, the market is bought up with the negative sentiments, including weak outlooks on companies, the economy, and the overall market. During this phase, many investors selling off their stocks in panic. Then the second type of trend is secondary trends. Secondary trends are corrective movements to primary trends. Primary trend is the main direction in which the market is moving, and an intermediate trend or secondary trend moves in the opposite direction of the primary trend. And it lasts from 3 weeks to 3 months. Here you can see a secondary trend. Here A and B are the primary trends, and the movements opposite to A and B are the secondary trends. In a bull market like this, the secondary trend can result in the fall of about 33 to 66% of the early rise. In a bear market, the secondary trend carries the price upwards and corrects the main trend. The correction would be 33 to 66% of the earlier fall. And the last type of trend is minor trends. The short-term trend or minor trends refers to the day-to-day price movements. Minor trends try to correct the secondary trend movements. Means it gives against the direction of secondary trend. It's better for investors to concentrate on the primary or secondary trends rather than on minor trends. Here you can see with that green mark some daily fluctuations which are in the same direction of primary trends and opposite to the direction of the secondary trends. These are the minor trends. So, as per Dow theory, there are 3 types of trends. Primary trends, which are the largest trends, last for more than 1 year, and the secondary trends, which moves in the opposite direction of the primary trend, and finally the minor trends. Okay, thank you.